Joining us today is Chirag Setulbad, who's Senior Fund Manager at HDFC Mutual Fund. We will be discussing with him HDFC Midcap Opportunities Fund. Chirag, good to have you on the show. Before we start off by discussing your fund, first tell us what's your portfolio strategy been, since Jan, since we saw the market rally?
Our strategy has not changed. We remain focused on high-quality mid-cap companies and large-cap companies as well. And there's been no significant change in our portfolio strategy since January.
But clearly, it's been very volatile for the market. Do you think the market has run its course with the kind of rally that we saw in 2012? What is the outlook on the market near term?
I don't think the market's run its course, but there could be a correction in the near term. If you look at the mid-cap index, it's rallied 26%, 27% since August. So that's a fairly sharp rally in a short period of time. So some amount of correction is possible. But I think when you look at the market from a longer term perspective, valuations remain attractive. We are trading at 14, 15 times 1 year forward earnings. That's close to historical levels. So we feel that returns going forward should be driven largely by growth, and growth we expect in India will continue to be at corporate earnings of 15 to 20% for our portfolio companies.
Chirag, mid-caps are being hammered out of shape, more so over the last few sessions. Could there be more selling, even if the Nifty stays stable?
If there is a correction, then one can expect in a correction that high beta names clearly will underperform. But we feel that high quality mid-cap names will continue to do well. So yes, if the market were to continue to correct and mid-caps along with it, then certainly the high beta names will bear the brunt of it.
Okay. So let's come to sectors. I mean, what's your sectoral preference, keeping the risk profile that you may have for investors in mind?
So our approach to risk has not changed. In our view, risk is understanding a business, and it's not necessarily reflected in beta. So we want to understand the businesses that we are investing as best as we can, and by doing that, we can mitigate risk to the best extent possible. So we are not changing by getting into high beta or low beta. We want to continue with our emphasis on building a portfolio of high quality businesses. I think that's the best way in which we can manage our risk, by staying within our circle of competence, by buying high quality companies. I think that's the fundamental risk management, which is what we would like to do.
Coming to your Midcap Opportunities Fund, banks and pharma are your top two sectors. The cumulative allocation there is pretty high. What's the rationale here from a value growth perspective?
Sure, we continue to be very positive on both those sectors. Banks, we feel that valuations, particularly on the public sector side, are attractive. We feel that growth is still reasonable. From a credit perspective, you will continue to see 13 to 15% growth. We feel that interest rates have already turned, and banks will be a beneficiary of that. And the last leg of, in terms of asset quality, we expect asset quality to improve going forward. We've seen some stabilization in the last quarter, and we expect that momentum to pick up. So public sector banks in particular are quite attractively valued at anywhere from 0.8 to 1.2 times book. With strong ROEs and reasonable managements, we expect that that space will continue to do well. On the pharma side, we find a lot of attractive companies. They're trading at anywhere from 14 to 15 to 16 times 1 year forward earnings. And growth is still reasonable, 15 to 20%. Each pharma company has a different profile. Some are more domestically oriented and some more export driven. But we continue to find the entire pharma space to be quite interesting.
Explain your rationale for stock selection within the banking space on the basis of value, where your focus clearly is on PSU banks.
Public sector banks, as I mentioned, are between 0.8 and 1.2 times book. Private sector banks are almost 3 times that valuations, and the 3x difference in valuations is not what we find in the quality of the businesses. So we feel there's a mismatch between valuations and quality of business, which is favorable in public sector banks, and that should do well for us over a period of time. In terms of asset quality too, the problems have been on the public sector side, so clearly the recovery will also be on the public sector side.
Chirag, where in the industrial space are you bullish? Where there is value, or where there is high beta? What do you like here?
It's a very stock-specific approach in industrial. So we look at independent companies and what their prospects are, and as a result, there are a number of industrial companies that we are quite positive on. Typically, these are light industrial companies as opposed to the heavy capital good companies, and these products are used more as consumables as opposed to driven by chunky capital expenditure, and therefore tend to be a little bit more resilient.
Chirag, with the rally we saw in large cap IT, mid cap IT emerged as a good opportunity. What's the call on the space here from an earnings perspective?
Again, we're positive on mid-cap IT. Mid-cap IT companies are trading at anywhere from 6 to 8 times multiples. And when looked at from an absolute perspective, that's a very attractive valuation. These are high free cash flow generating businesses. Managements are very strong. And we feel that the outlook for the business is reasonable. The sector is looking somewhat stable now, but I think the individual companies, their profile will depend on what they do with their clients and in their particular segments more than the overall industry outlook. So we remain positive on mid-cap companies.
Right. What about return expectations month on month? What is it that you're targeting in terms of what this fund can return?
Valuations are reasonable at 14-15 times, so returns are going to be driven more by growth. And from a 1 to 2 year perspective, 18-20% growth is something which is achievable. And as a result, that is the broad kind of returns that we would expect over that time frame. Volatility is not necessarily a bad thing. If you buy into dips sensibly, then one can actually add to that 18-20% return.
Right. For any fund manager and market watch, Chirag, the focus would be on the budget. How are you seeing it as an event risk?
I think there is a lot of speculation that the budget will have populist measures. We don't think that will transpire, simply because the government has very little maneuverability in terms of bringing out those kind of measures. We think that the budget will be balanced and won't pose to be much of a challenge.
Chirag, finally, what would be a clear avoid as part of your investment strategy to this fund?
We have stayed away from segments where we either don't understand the businesses or where valuations are not on our side. We have historically stayed away from commodities, particularly international commodities, where it is quite difficult to get an understanding on how prices will move. We've also historically been quite light on the real estate segment.